The Ensemble podcast is intended for professional financial advisors. All discussion is limited to publicly available information and should not be interpreted as legal, professional, or financial advice. Ensemble does not hold an AFS license nor provide any financial services. Before making investment decisions, you should obtain financial advice from a qualified financial advisor.
Hi everyone. This morning I'm joined by Alex Cousley, who's the Chief Strategist and Portfolio Manager here with me at Russell Investments. Alex, I know we spoke on what we'd call Liberation Day. We're now almost at the end of that moratorium around tariffs, and really a lot's happened, both geopolitically and also economically. Do you want to just step us through what's happened and maybe what that means for markets?
Yeah, absolutely. So since Liberation Day, we had the 90-day pause that is due to end in early July 8th. It seems that we are heading in the direction where the pause will be pushed out. The US is...
Oh, really?
Yeah, the US has talked quite a bit about we're getting close to deals with Japan, South Korea, India. There's a number of other nations. And so it seems that they're getting us ready to sort of say, well, we can push it out a little bit more and we'll have these deals ready. On the economy side, there was a lot of worry amongst some market participants that the survey data, so consumers get asked how the world is looking at, business executives get asked, and quite frankly, they said it was awful. But when we looked at spending data, hiring decisions, everything was tracking quite well. So the economists call it hard versus soft. So the soft data is the surveys, and they'd fallen down a lot. Hard data was holding up. And as we sit here today, the soft data has been inflecting higher as people realize that the tariffs, the worst case tariffs, is not going to happen. The final bit of that's been injected into the global market right now is around geopolitics and what is happening in the Middle East with the surprise US bombing of Iranian nuclear facilities. The market reaction on Monday morning, Sydney time, was very muted. I think most people thought it would open up a bit more. And the general sentiment is that the ceasefire has been achieved and that Iran's response was generally on the softer side or the more measured side. For us, geopolitics is very hard to forecast. For us, the main focus is around the price of oil and the Strait of Hormuz. So 20% of all oil goes to this tiny piece of waterway that is at the south end of Iran. Everyone worries whenever there is tensions that the Iranians will close the strait and stop all that oil coming out. It seems unlikely at this point. One of the big things is Iran has one friend, China, and China buys all the oil. So if you close the strait, you frustrate China. Not a great thing for them to do. What level of oil would we be worried about? We're trading at 60, 65 right now. I think if we went towards $85, $90 a barrel, that starts to increase economic slowdown. If we went up to 110, 120, that is when we get worried about global recession. So we're quite a way away from that, and we're a week in, but it is encouraging that tensions seem to have come off the boil a bit.
Okay. Well, I mean, you see that many probably watching this podcast are probably on their way to do the trust fund triangle, the Italy, Greece and Spain over the coming month. The flights to Europe from Australia are now 2 hours longer because of the rerouting in many cases. Has that impacted the oil price?
No, not really.
Has it impacted airfares?
No, not yet. Not that we've seen. From what I understand of some of the airlines, they have been absorbing their cost and not passing through to consumers. That doesn't apply to all of them, but what we're seeing so far, it appears that is the dynamic. And then on the oil price, it has been very muted. So far, we haven't seen much of that. And depending what happens, that could be a fairly short-lived phenomenon of planes having to divert.
Yep, fair enough. So what does all this mean? Again, let's start with the US. Is our risk of recession in the US still fairly low?
Yes. So it was 30% at the start of the year.
Mm-hmm.
30 is not zero, but it's it is higher than normal, but it has been higher in the past. Um, it went to 40% in our mind during Liberation Day at the peak of the worries,
Yeah.
just because there was a huge drag on the consumer, and it's come all the way back down. So we've basically done a full circle back to 30. And
Okay.
yeah, looking more broadly, other economists, quite a few went to base case recession on
Yeah.
Liberation Day and have pulled back as well. So that general dynamic of recession risk rising and then it's fallen in the last 2 months is quite universal.
Okay. If we now move on, let's go to China. So China buying all its oil out of the Middle East, keeping the Strait open. What's happened in the Chinese economy all through this period?
It has been a bit of a status quo where the economy is ticking along. It's been generally soft. The one thing that had come through at the start of the year, we were starting to see signs that the housing market was unthawing. So China's property market was in big trouble for 3 years. No one wanted to buy property. And China's government had been saying or putting policies in place to try and encourage people. And at the start of the year, we started to see that that was actually working. We were seeing small pickups in transaction volumes.
Mm-hmm.
And in the most recent consumer spending numbers, we've seen a bit of a pickup in housing-related expenditure.
Yeah.
The other thing that is happening is there is a huge trade-in program. So China is encouraging people to buy new phones, new washing machines, new fridges, you name it.
Oh, yeah.
And they're doing it. They are going and buying stuff. So that is kind of providing a bit more fuel to the retail sales for now, which will fade over the rest of the year. But, I think we're kind of tracking pretty closely to what we thought at the start of the year.
Okay.
Brought to you by Ensemble CPD. If you're analyzing portfolio research, meeting with asset managers, and attending economic briefings, you're already investing in your professional development. These activities all build the technical competence your role demands. It's time they counted towards your CPD requirements. Ensemble makes it easy to turn the investment research you're already doing into compliant CPD. To make your insights go further, go to ensemble.com/CPD.
So just to summarize our first two key points, we see that there's no increased recession risk in the US, as pretty much the status quo, jobs, consumer spending, etc., all remain kind of on track. And then in China, there's been a slight increase in consumption by the sounds of things in consumer durables, and you're seeing a reasonable kind of pickup in the housing market there. But all in all, it's pretty stable. Their economy is reasonably stable and trucking along.
Yeah, that's a great summary.
Okay. So now let's talk about Australia. So, my three favourite things in Australia are always interest rates, housing, and unemployment. So why don't we start with interest rates? Will we get a cut in our interest rates in July?
Yes, so we do think we will get one.
Mm-hmm.
And there's two things. So the first is they've been worried about the global outlook for a little bit. That is pushing them towards wanting to cut interest rates. And then we got the inflation report for the month of May just this week.
Mm-hmm.
And it was a little bit softer than people had expected. And the core inflation number is now actually below the midpoint of the target. So we are firmly in the area where they can cut once more. Looking at the rest of the year, I think there's probably a decent chance we get one more rate cut, but I suspect they're going to sit and wait for a couple of months. Because they've already done a couple of interest rate cuts. The housing market, which to your second point, the housing market seems to be going quite well. There is quite a lot of demand. People have been, if you've been sitting on the sidelines, you don't have to worry about interest rates coming down anymore. Going up anymore.
Yeah.
That has a multiplier effect on the economy. And so I think they're going to be willing to just sit for a couple of months and see how is this all playing out? What is happening with consumers? Are they spending those extra, the increase of disposable income after interest costs? Or are they saving it, putting it into offsets? Once they have a better sense of that, I think they come back in November and that's more of a live meeting.
Mm-hmm. And now, employment numbers in Australia, how are they tracking?
The employment numbers are okay. Like they're kind of tracking pretty close to. We're not far from the natural unemployment rate. So It's a very dorky economics term, but it's kind of the point at which you're not putting pressure on inflation.
Yep.
We're still a little bit below that, but we're not. It's not a super tight labor market. When we look at forward-looking indicators of labor demand, they're pretty soft, but they haven't deteriorated over the last couple of months. So we're kind of sitting in this range where, the proverbial 20, 25,000 jobs a month is probably what we're looking at for the next couple of months.
Okay. And then for all the travelers out there, the US dollar, Australia to US dollar, Australia to euro. Let's start with the Australian to US dollar first.
Yeah, so the Australian to US dollar, so you might have recalled during Liberation Day, we bought hedged global equities on a view that the Aussie dollar would bounce. We're at 59.60 then. We're now at 65.40. So that so far has worked out well. We think there's more to go. So probably 70 cents sometime in the next 6 to 12 months is probably a decent place to be thinking about. There's two angles to this. From the Australian perspective, rates are coming down, but they're kind of coming down pretty gradually. And if anything, the market is a little bit more dovish than we think is appropriate. So the market thinks more rate cuts. As that adjusts, that pushes the Aussie dollar up. The other angle, and we wrote about this in our global market outlook that was released this week, the idea of US exceptionalism and the US dollar being the the exceptional asset. We don't think it's broken, but just a little bit less exceptional. I should put a bit of weight on the US dollar. So that kind of gets you to 70 cents, maybe a little bit higher than that over the next 12 months. But 70 is probably about right. The Aussie euro is a bit less clear. I think we still see a bit of upside, but it's probably not as a pound the table as it is for the Aussie US. We're trading at 56-ish right now against the euro. Kind of, I would think like 57 and a half is probably more likely where we're going to sit.
Yeah.
The one thing that's a bit different is for the euro, there's a lot of excitement about European fiscal spending. They spent a lot less money on defense. To the extent that pushes the growth environment higher for Europe, that's going to be a bit of a constraint on Aussie dollar rising against euro.
Yeah. Okay. So now my last question, and I always ask this, if you bump into me in the street or in Martin Place or something and I ask you what's going on, what are the three things my clients need to know about the market? So if we go America, China, Australia, which are the key things that most people end up asking about? Yeah, would you tell me?
Okay, so for the US, the key thing, so the Federal Reserve, likely to cut rates twice this year. That's still on track. The economy is tracking for a soft landing. Recession risk have come down. That's probably the second one. And the third, very important for markets, is corporate earnings. So first corporate earnings, very healthy and have been surprising to the upside. For China, I think the main focus is the corporate performance is improving, even though the economy is not great. So that's encouraging. The second is we really need to focus on the consumer and whether this is a robust recovery. And the third is we're probably going to see something in the way of stimulus in the next 6 months that will provide a bit more support. Hopefully for Australia, that would be around construction because iron ore price has come off a little bit. And then for Australia, the RBA likely to cut rates. The Aussie market we think is fully valued. So there's a lot of good news in the Australian market already. And we've been trimming some of our Australian risk relative to global. The key watch point for me, and I don't know where it will land, this productivity commission and this productivity push from the Treasurer. If they can be successful in that, that is a pretty big positive for Australia because we have had very soft productivity for 4 years now, even longer. If they can get some dividends out of that, that would be quite a positive story for Australia.
Great. Alex, as always, thank you for your time. And thank you for your very clear, concise summary, which I find extremely helpful. Thank you.